listeners, welcome back to my YouTube channel. Today we will continue where we have stopped in our previous discussion of chapter number 12. This is accounting for partnership. We have discussed learning objective number 1, in which we talked about what is partnership and how do we account for the formation of partnership. Then we also concluded the learning objective number 2, which was about net income or net losses of the partnership. Today we will start our discussion with learning objective number 3, which is how do we treat the partnership in case of liquidation. Liquidation means that they are closing the business and how you're going to treat it. Before moving on to the liquidation, let me just quickly go through the financial statements in which we will only be discussing the part of partnership, means the things which are different than the sole proprietorship. In financial accounting initial chapters, you have already studied that how to prepare the balance sheet and income statement for the partner for the sole proprietorship. There is no difference in the financial statement of sole proprietorship and the partnership, except few variations. So I'm going to show that those variations to you, and then we will move towards learning objective number 3, which is regarding the liquidation of the partnership. Starting with the first statement, which is a capital statement of the partners. This statement shows us that how we treat the partners' capital, or how do we incorporate the changes in the partners' capital with the passage of time. Like in the previous recording, I have discussed with you that how do we distribute the net income or net losses to the partners when the company close its financial year. So those incomes increases the partner's capital account, and the losses that decreases the partner's capital account. Let me show you the journal entry we have discussed. If you remember, this is the distribution of the net income of 22,000 to Sarah and Ray. They both share, and we prepare the schedule of distribution of the net income. So I'm going to take the same example of Sarah and Ray, and I'm going to show you that how the parts of financial statements look like for them. So firstly, I will be starting the preparation of the partner's capital account. If you see here, in addition to the net income, which I just showed you, we will be given some additional information. So additional information here in this example is we have the information of additional investment by the king. During the year, Sarah King has invested $2,000 in the partnership. And also, Sarah King has withdrawn 7,000 from the partnership, whereas Ray Lee has withdrawn, or he has drawn $5,000 from the business. These drawings and investments are exactly the same you did in the sole proprietorship, where the owner was doing drawings and he was doing the additional investment in the business. So same thing here, but the only difference is here we have partners, means more than one owners. Okay, when we consider all these things, what are all these things? The distribution of the income, changes in the capital account of the owners, and if there is some additional information like investment and drawings, we can prepare the partners capital statement. So here comes the Kingsley company partners capital statement for the year December 31st 2017. Now here, if you see the first column I have for the description, the second one is for Sarah King, means first partner, third one is for the second partner, and then the total column. Initial balance of the capital were given in the question statement that Sarah has 28,000 opening balance of her capital account, whereas Ray has 24,000. So together the total capital was 52,000. Then in the previous slide, I showed you that Sarah has done additional investment of 2,000, so it increases her capital. The 2,000 are being added in her account. And then when we distributed the net income among the two partners by preparing this schedule of division of net income, and then when distributed, total net income was 22,000. Sarah got 12,400. Ray got 9,600. So the same has been added in the Sarah's capital. Sarah has 12,400, whereas Ray has 9,600, and the total income was 22,000. When we added the additional investments, first we did all the additions. So additions are additional investment for Sarah and the net income for Sarah and Ray. So let's make a total of all the additions to the partner's capital. So it comes up 42,400 for Sarah and 33,600 for Ray. If you add these two, that is 76,000. Then I also showed you that Sarah did some drawings of $7,000 and Ray has done for $5,000. So drawings decreases the partner's capital. Exactly the same way drawings of owners, sole proprietors decreases their capital. So partnership's capital is also decreases because of drawing. 7,000 and 5,000. If it decreases the capital, so 42,400 is going to change to 35,400, and this is the ending capital balance for Sarah because no other changes happened. Whereas Ray has 28,600 after decreasing the drawings from her capital balance, and we add the ending capital balance that comes up 64,000. In conclusion, partners' capital changes if there are additional investments, if there are drawings, and net income and net losses. So these are the items which affects the partner's capital. When we prepare the updated partners capital with the help of partners capital statement, now the end balance sheet will have Sarah's capital of 35,400, whereas Ray capital of 28,600. I'll show you the balance sheet part for the capital. We assume that the total liabilities are 115,000. I'm putting honors equity, and now in honors equity I have Sarah and Ray, both capital are given. We just calculated these balances 35,400, 28,600. So total capital balance is 64,000, and the total of liabilities and equity is 179,000. Rest balance sheet has no change. We have assets on asset side, we have liabilities on liability side, and under the liability we add owners equity. The change in the sole proprietorship and partnership balance sheet is only the part of equity. This is how the partner's financial statements looks like. Now let's move towards our third learning objective, which is partnership liquidation. And in partnership liquidation, we will be liquidating the business. It's not the cancellation of partnership contract, it's the closing of business. The partnership is being liquidated, it is going to be closed. So we have different cases in this partnership liquidation. If you remember, when I discussed with you the characteristics of partnership, I told you that the liabilities of partners are unlimited. Unlimited means that their personal property could also be used to pay for the partnership debts if they are more. And I also informed you that if one or two partners are bankrupt or they don't have enough resources, personal resources to pay for their claims, their liabilities, then in that case other partners they will be handling the deficit of this bankrupt partner. So keep these things in your mind and let's move towards this partnership liquidation case. In the first case, which I'm going to discuss with you, that is no capital deficiency. No capital deficiency means that business is in a good state. When you sell all the assets, you have enough money to pay for the liabilities, and remaining money was distributed among the owners. So this case is known as no capital deficiency case. After this, I'll discuss the second case with you, which will be having capital deficiency. Means after paying for the liabilities, we still need some more money to pay for remaining claims. And then in that case, one of the partner will be in the bankrupt, will be having negative capital balance, and he will pay from his personal property. So that will be deficit case, but the partner has enough personal resources that he can handle that. Third case is also a deficiency case, but in that case, we will treat one of the partner as bankrupt, means he doesn't have enough personal resources even to pay for the liability, to pay for the business claims. So the other two partners will, handle his claims, his liabilities. So moving on towards the first case, which is no capital deficiency. I have a different data set for this learning objective. So now Sarah and Ray example is over now. This is a new example. Ace company is liquidated when its ledger shows the following assets, liabilities, and owners' equity accounts. So on the asset side, we have cash, accounts receivable, we have inventory, we have equipment, we have accumulated depreciation for the equipment. On the liability side, we have notes payable, we have accounts payable, and three partners are there: Arnett, Kerry, and Edson. Sorry, Eton. So if you see here, all of them, their capital balances are mentioned. Arnett has the second maximum capital balance of 15,000. Kerry has the maximum capital balance, and Eton is having the minimum capital balance. Moving on towards the data discussion. So the partnership of S company, they agrees all the partners that they are going to liquidate their business. We have two set of information. The first one is the partnership will sell its non-cash assets to Jackson Enterprises. So Jackson Enterprises is another business, and they are purchasing S company's assets, and they are saying that they will pay $75,000. Remember, they are selling non-cash assets. So the first step, sell non-cash assets and get the money. So they are getting 75,000. The second thing is the partnership will pay its partnership liabilities. So Jackson is not handling their liabilities, they are only purchasing non-cash assets. Liabilities partners have to pay by themselves. So the partnership business, whatever money they get, they will distribute this money to the creditors to pay their claims. And then the income ratio of partner is 3 is to 2 is to 1. What does it mean? 3 respectively means the first partner, who was the first partner? Aren't is going to have three parts uh, of the whatever distribution is there. 2 is with second partner, who is Carrie, and Eton is going to take 1. So it means whatever things are there, either it is profit, either it is losses, I'm going to use this ratio. 3 plus 2 plus 1 is 6. So whatever, let's suppose if there is a gain, I have to distribute 3 by 6, means out of 6 parts of the gain, 3 parts will be taken by Arnett. And then the second partner will take the 2 parts out of 6 parts, and 1 part, 1 by 6, will be taken by the third partner. So like this, we are going to distribute the income among the partners. Let's move on towards the steps, perform the steps and record the journal entry. So all the non-cash assets were sold out. So this is the balance sheet again. Can you see non-cash assets includes accounts receivable 15,000, inventory of 18,000, equipment of 34,000, but there is accumulated depreciation of equipment. So when equipment will be removed from the book, also its accumulated depreciation will be removed. Accumulated depreciation, as we already know, it has a normal balance of credit. So let's perform these steps. They are getting 75,000 from the purchaser, the company who is purchasing, who is the company that is Jackson Enterprises. Jackson Enterprises is paying them $75,000. Now let's remove all the assets. Accounts receivable is getting credit because we are removing it. We are giving it to Jackson. And inventory is also getting credit, and also equipment. At the same time, I'm debiting accumulated depreciation of equipment. When we make a total, so on the debit side, I'm going to have 83,000. 75 plus 8 is 83,000, while on the credit side I will have 15 plus 18 plus 35, which is less than the debit side. It means that we sold all these assets on gain. Can you see over here? We get $75,000 by selling our non-cash assets. If I put non-cash assets over here, this is accounts receivable, then inventory is 18,000, then equipment is 35,000, but it has accumulated depreciation, so I'm subtracting it. So my assets were 60,000. So I have a gain on realization of these assets, that is 15,000. Now my journal entry is balance debit is 83,000 and the credit side is also 83,000. So we get gain. this gain should be shared among the partners, right? So 15,000 is the gain. The profit and loss distribution ratio, I already told you, 3 by 6 for first partner, 2 by 6 for the second partner, and 1 by 6 for the third partner. So let's distribute this profit among the partners. So gain on realization, I'm distributing it. It's going to be finished. So gain on realization will get debit. Earned capital will get credit. 15,000 was the full gain, and he is taking 3 by 6 of it. So his capital will increase with 7,500. 15,000 was the gain, 2 by 6 is taken by Kerry. So his capital is going to increase with 5,000. And Aton is going to take 15,000 multiplied by 1 by 6. So 2,500 is taken by him, right? After this, let's distribute the remaining profit, but we need to see that, sorry, not profit, remaining cash, but we need to see what is the status of cash. So let's prepare the T accounts. But before that, let's pay the liabilities. So all together, we can finally know what is the situation of the cash. So if you see over here, the liabilities are not payable and accounts payable. So I'm going to pay the liabilities now. So they're going to get debit and cash is going to get credit. Now, next step is we need to see how much remaining cash is left and what are the capital balances for the partners so that we can pay them. So I will not discuss this journal entry. Firstly, let me show you the T accounts. Then on the basis of these T accounts, I can distribute the cash for the journal. Then I will prepare the journal entry. So let's have a look at this. Firstly, the cash account. The opening balance of cash account from the data set was, let me show you, this was over here 5,000, right? Then we sold the assets for 75,000, and then we paid the liabilities for 31,000. So let's check the changes. Cash T account balance opening is 5,000. Then we debited 75,000 because of journal entry number 1, and the journal entry number 3 has taken the cash of 31,000 to pay to the creditors. So altogether remaining cash with the partnership is 49,000. Now let's check updated capital balances for all the partners. So if you see here, this is my balance sheet, opening balance sheet. Ant has 15, Carrot has 17,800, and Eton has 1,200. But we distribute them gain. So by distributing the gain, their capital balances has increased because of journal entry number 2, right? So let's check the ending balances of the T account. I prepared their T account, Arendt, Carry, and Eton. If you see here, when I added the gain distribution to their accounts, their balance becomes 22,500, 22,800, and 3,700. So these are the balances. If you add them, that is 49,000, and easily I can distribute the cash. It's a check as well. If the balances are not equal to the cash, it means that you did some mistake in solving the question. So let's distribute. Aren't capital gets debit because now we are paying him finally. So his claim will be paid off and he'll be removed from partnership. Carrie will also get his claim back, and Eton will also get his claim back, and all the cash will be distributed. Now there is nothing left in the balance sheet of this partnership. Let's prepare the cash payments schedule. If you see here, I have this schedule shows us that now ending balances for the full partnership balance sheet is 0. So how do we prepare this? Firstly, write the name of the company is company, schedule of cash payment. What are the items? Don't take independent items from the balance sheet. Cash from the assets will be mentioned separately. All the non-cash assets will be mentioned together. Okay, because one journal entry is there to remove them, is equal to all the liabilities will be mentioned together, not separately. And then the capital balances will be separate. So cash will be separate, balances will be separate, but non-cash assets and liabilities will be together. Okay. Starting with the opening balances from the opening balance sheet, which I showed you many times. And then the first journal entry brought 75,000 cash. Also, Second journal entry has to do with this sale of non-cash asset and allocation of gain. So 75,000 cash was brought when you sold all the 60,000 assets to the another company. So the difference between them is 15,000, which we have recorded as gain on realization. But in balance sheet, no such account is there. So second journal entry, which was distribution of gain on realization, has increased the capital balances. So I mentioned them here. Okay, now check your debit and credit side. Updated cash balance is 80,000 now. There is nothing on the non-cash asset. I still have liabilities of 31,000 and the capital balance is increased to this updated one. Now check your debit and credit side total. It is 80,000 on the debit side, 80,000 on the credit side. Third step, what we did, we paid the liabilities. When we paid the liabilities, 31,000 cash was gone and 31,000 liabilities were also paid off. So I'm putting it in bracket because I'm removing them from my books. So now updated cash balance is 49,000. No non-cash assets are there, no more liabilities, and these capital balances are there. And then we paid them. So cash is finished, all the capital balances are gone. So ending balances, final balances after the liquidation are zero. This was the simplest case in which no capital deficiency was there. You was able to sell your non-cash assets on gain, and then the gain was also distributed to the partners, and then ultimately partners get their claim back from the business. Now let's see a different case in which we have a capital deficiency situation. So this is updated. This is another balance sheet for the same company. We are assuming some more different facts and figures. So if you see the asset side, there is no change. Liabilities are still not changed. Uh, Capital balances are also almost the same. Let me just quickly see. Yes, but the difference is the sale of assets. So let's check what is the difference. S company is on the brink of bankruptcy. They sell merchandise at substantial discounts and sell the equipment at auction. Cash proceeds from these sales and collections from the customers totals 42,000. So they say that they sell their merchandise, which is inventory, in a very poor rate. What is inventory? 18,000. And they sell their equipment also on poor rates, and they were able to get 42,000. So cash proceeds from the sales and collections from customers total to 42,000. So altogether this was what they were able to get. um, Poor prices of inventory, less collections of customers, means accounts receivable, and the auction sale of their equipment enabled them to get 42,000 only. Now let's record this journal entry. So the cash, they get 42,000 because the equipment was all sold, so its accumulated depreciation will also be removed. Accounts receivable were collected, inventory and equipment, all of them, when we add them together, um, they are there is a loss company is having. So why the company is having the loss? If you add all these three, this will be 68,000, and then on the debit side there is only 50,000, so 18,000 was the loss on realization. Just like we distributed gain on realization immediately, so I'm going to distribute the loss on realization to the partners. So loss on realization will get credit now. Same distribution ratio, 3 by 6, 2 by 6, and 1 by 6. So partners capital decreases because of losses and drawings, right? So this is a loss, so it's going to decrease the capital balances. Then the partners paid their liabilities. The notes payable and accounts payable both were paid off, and 31,000 cash was used. After this, let's check the situation of accounts. So if you see here, the cash balance before liquidation was 16,000. Why 16,000? Because we have opening balance of 5,000, plus we get cash of 42,000, so that's 47,000. But then we have paid our liabilities of 31,000, so cash reduces, so my remaining cash balance was 16,000. Aren't this cash balance we still have? This is actually a small statement. You can also prepare the T account just like the previous question. So cash is debit, so that's why I'm putting it as it is. Arnett Capital, it's his opening balance was, if you see here, it was 15,000, but he shared the loss of 9,000, so his capital balance is 6,000. Carry opening balance of capital was 17,800, and then he shared the loss of 6,000. So ultimately, his ending balance is 11,800. Now, why I put brackets over here? Because the capital balances are credit. So since debit balance, I'm putting without brackets. So to indicate the credit balance, I'm putting the brackets. Okay, and then it, it on. Let's check. His opening balance was 1,200, and he shared the loss of 3,000. His capital was only 1,200 credit, but debit come 3,000. So now he has a debit balance of 1,800. I just explain you the first row, which is balances before liquidation. In this example, the case is that Eton used his personal property to pay off his debit balance of capital account. So he has to pay. Credit means they have to take back from the partnership, but debit means they have to pay to the partnership. So he has to pay 1,800 to the partnership. So he used his personal property and he paid to the partnership. So when he made the payment, partnership gets the cash of 1,800, and his debit capital balance was removed because he paid to the partnership. So when he paid, cash gets debit and Eton capital gets credit. So this credit has cancelled the debit, and now Eton has nothing to do with the partnership. These claims are over. Now after this, now cash is 17,800, earned claim is 6,000, and carry's claim is 11,800. So remaining cash 17,800 is going to be distributed to these two partners. Their capital will remove and the cash will be distributed. The next case is okay, students, here you can also prepare the cash payment schedule exactly in the same way we did for the first case. Okay, let's move towards the last case, which, one second. Okay, this one what we have discussed. Now let's move towards the last case in which Iton does not have any property with him, personal property with him, so he's unable to pay. So in that case, that feature of the partnership will be applicable, that each partner is individually and personally liable for the partnership. So if you see here, now the remaining two partners are going to adjust his claim. Okay, so these are the opening balances, just like in the previous case I explained you. 16,000 cash, Arendt has a claim on the business 6,000, and Carrie has a claim of 11,800, and Eton has to pay 1,800, but he says I don't have money and he proves that he is bankrupt. In that case, other two partners are supposed to share his loss. So his loss was 1,800. So this is not, sorry, Farley, this is Eton. 1 second. Okay, so Eton capital will get credit because now Annette and Carrie are sharing it. Now how they are sharing it? 2 by, now see here, the profit and loss sharing ratio for Arendt was 3 by 3. I'll just write the ratio right now because I cannot write 6. And the carrier was supposed to share 2, and Eton used to share 1, but Econ is not sharing. I cannot divide 3 by 6 because now there is no more 6 parts. There are only 5 parts. So 3 by 5, and carry is 2 by 5. Okay, so 3 by 5 of 1,800 is 1,080, and 2 by 5 is 720. So now the capital balances of Arendt and Carry are going to be reduced by debiting it. So now because of debit, I'm not putting any brackets in the table above. So now remaining claim of Arendt is 4,920 and 11,080 for Carry. The cash will be distributed. The remaining cash is 16,000. Arendt will take his claim, and Carrie will take his claim. This is it about the discussion of learning objective number three. As I mentioned, for case number um, two, which is capital deficiency, and case number three, which is capital deficiency shared by the remaining two partners, um, you can prepare the payment of cash schedule, and it is advised that please prepare the payment of cash payment schedule for the remaining two cases as well. I hope the lecture was helpful for you. I'll come back again with the chapter number 13, which is about companies, in a while. So I'm going to discuss questions for these chapters as well in my upcoming videos. Please like and subscribe if you want to get the notification of the upcoming videos. And see you next time with the next video. Take care.